We say this, I mean, we have to take a little bit of a longer-term perspective than just today, because you do have treasuries being bid up in the yield on the 10-year, for instance, at session lows of 2.1957%. But it's been a bit surprising.
It has been surprising that it hasn't been more,
exactly,
frankly, because so much bad news has come out. I mean, let's be clear. You've got China's, $8 trillion stock market having a particularly horrible couple of weeks, and the government being unable to do anything, on top of Greece, on top of what's going on in Puerto Rico, on top of less exciting news about the U.S. economy. So, you are seeing yields come down somewhat for the 10-year U.S. Treasury, but they can't go down that far if you think that the Fed is actually going to hike. I mean, think about what happened going back 2010, 2011, the last time you had these sort of Eurozone crisis talks heating up. You saw the 10-year U.S. Treasury fall from, 3.6% down to almost 2%, and the same kind of move on the German 10-year Bund yield, also going down about 1.5 percentage point. How can you see that if you've got the 10-year German Bund yield at 0.6% now? I mean, you cannot go, maybe you can, I don't know, to negative 1%. It's happened before, but
buyers went on strike in Germany when the Bund yield got too low, and a lot of people are saying the Bund market once again is setting the pace for global bond markets. Bob Sinch over at AppSpec has just put out a note on this, Amber Securities, saying that the Bund market is setting the pace. The question is, where is the safe haven then? If you're not finding it necessarily in the Treasury market in German Bunds, is cash the ultimate safe haven right now?
This is a phenomenal question that a lot of people are asking. Since so many central banks have engaged in unprecedented stimulus programs through the bond markets and sent yields to such low levels, there has become a growing amount of volatility during times of stress because these bonds are not providing the same kind of haven. There isn't the same kind of room for yields to go down that there once was. And if there is any sign of growth or any sign of recovery, those yields are going to bounce right back because we're nearing the point where you're not getting a real rate of return on these bonds if the economy is continuing to accelerate. You are seeing Swiss yields today flirt with negative territory again, the 9-year yield and the 10-year yield there. That is probably because people are expecting a possible recession in Switzerland because of the stirring think franc and because of some other circumstances. Unless you think the same thing is going to happen in Germany and the U.S., it doesn't make the same kind of sense.